You should borrow from your 401k to pay debt. I am about to touch the third rail of financial planning by saying you should borrow from your retirement plan at work in order to pay down debt. The idea of never touching your retirement money for anything other than retirement is so sacrosanct in my industry that I will assuredly be labeled a heretic and forever banned from the business. I don't care. I care more about bringing you common sense methods of organizing your finances to reduce financial stress. Now, for those of you who don't have a 401k from your employer, say you are self-employed, work for an employer who doesn't offer a retirement plan, or are even retired, hang on. Later in this chapter, I'll bring up some specific points that apply to you. For right now, though, the focus will be 401ks because there are some unique planning concepts to a 401k that are not applicable to any other account. I must add here that I'm also speaking of 403bs. A 403b is similar to a 401k, but is mainly offered through government agencies like a school district or hospital. Wherever I refer to the 401k, please keep in mind the information applies to most 403bs as well. Just so we're all on the same page here, let me explain what a 401k is. A 401k is a retirement plan provided by some employers as a way to incentivize its employees to save for retirement. In the old days, the company took care of its employees in retirement by providing a pension. An employee worked for a company for 30 years or so, and that company provided him some fixed amount of monthly income at retirement. The employee didn't have to do anything other than show up at work for those 30 years, and when he retired, he'd get that pension check each month. Those days are gone. The 401k replaced the pension, and now retirement is solely the responsibility of the employee. So in order to induce employees to save for their retirement, the tax code provides favorable treatment for retirement plans like the 401k. One significant benefit of the 401k is called a match. The employer may put a portion of cash into the employee's retirement account, XW the employee also puts money into his own account. For instance, you, the employee, contribute $500 to your retirement account. The employer may also put in $500. Thus, your account balance is worth $1,000, though you only put in $500. That's a huge incentive for you to contribute because you are literally getting a 100% rate of return on the $500 you contribute. It's awfully hard to beat that rate of return on your money. After many years of contributing to your 401k, plus the company match, and with hopefully decent investment returns, you can find yourself with a lot of money squirreled away. The tax code treats 401k plans favorably by allowing contributions to the employee's plan to be pre-tax and to grow tax-deferred. So in the example above, the $500 you put into your 401k was not taxed. The $500 the company put into the plan was not taxed either. You now have an account worth $1,000 on which you paid no tax. Say the account grows to $2,500. That growth is also not taxed. Until you take money out of the account, you pay no taxes. Not too shabby, right? In fact, many people's income in retirement comes from two places, Social Security and their retirement accounts like their 401k. This makes the 401k a very important account, not to be taken lightly. However, a 401k also offers an opportunity that no other account types offer: the ability to borrow from it without paying tax on the amount you borrowed. You can't do that in an IRA, a SEP IRA, a simple IRA, deferred compensation, a non-qualified account, or anything else. Only a 401k and its sister account, a 403b, allows this flexibility. The ability to take a lump sum distribution from your 401k for any reason is what makes it so unique. However, to be able to easily borrow from your 401k makes financial advisors nervous. They don't want you to look at your 401k as a piggy bank. They worry that if you tap into your retirement money, you'll never put it back in. After all, your 401k will be a huge source of your income in retirement, and they don't want you to spend it down now while you're still working. Also, if you leave your job after you take money out of your 401k but don't put it back, That money will be taxed and penalized if you are under 59.5. For all these reasons, they advise clients to use extreme caution when even contemplating borrowing against a 401k. I happen to agree with these assessments, actually. Where I disagree is that just because a retirement plan should be used for retirement does not mean you should not use it if another situation arises where it makes sense, like paying off debt. Think about it. If I assume my retirement account will grow at a non-guaranteed 6%, and my credit cards are costing me a guaranteed 10% interest, why would I not pay off my credit cards with an investment that is earning less than what I am paying to the bank? In fact, not only is my 6% assumed growth not guaranteed, there is a 40% chance that in any given year I will lose money on my balance. Historically, the market goes up 60% of the time and goes down 40%. With my credit card, though, I know for a fact that every year I will pay them 10% interest. So let's crunch some numbers and see why it makes sense to borrow from your 401k in order to pay off debt. Now remember, this only applies to those with a 401k balance. You cannot borrow from an IRA in the same way. Just keep that in mind. Let's say you have $50,000 in your 401k. You also have $10,000 in credit card debt that costs you 10% a year in interest. Your expected rate of return on your 401k is 6%. Should you borrow from your 401k in order to pay off the credit card? When you borrow from your 401k, the balance must be paid back in 5 years with interest. The interest today, August 2017, is about 5%. But that 5% interest is not going to the bank, it's going back into your account. In this case, with a $10,000 loan at 5% interest, you will pay $188 a month for 5 years. This means that after 5 years, you will have put $11,280 back into your account. I cannot stress this enough. You are literally paying interest to yourself. There is another critical point that I believe a lot of financial advisors overlook. Not only does each $188 payment you make include the 5% interest you pay to yourself, but those payments may also grow at your assumed rate of return as well. In this case, the 6% we previously mentioned. So unlike a credit card where the 10% interest goes to the bank, borrowing from your own money means the interest actually goes back to you with growth. So if you borrow $10,000 and your money grows at 6% a year, after 5 years, you'd have $13,117 in your account. Again, just to reiterate, you took $10,000 out. In 5 years, you'd have $13,117 back in your account. Look at Table 5. The left side shows what the account would look like if you didn't touch the 401k. With 6% investment returns, your $50,000 grows to $66,911 after 5 years. On the right side, you took the loan out, which drops the initial account balance to $40,000 in year 1. But paying $188 for those 5 years and also getting that 6% investment return means you'd have $67,070, $159 more. Oh, but the fun doesn't stop there. Table 6 shows what happens if you leave that $10,000 in your 401k and instead pay off that 10% credit card with the same $188 a month as you would have put towards your 401k loan. After 5 years of paying $188 toward your 10% credit card, you still owe $1,722. The end result is that by borrowing against your 401k to pay off your credit card, you have actually increased your net worth by nearly $2,000. Now, be advised, there are lots and lots of different ways to play out this scenario. What if you got a 0% teaser rate on a credit card? Should you take advantage of that and keep your money in the 401k? What if you expect your investments to grow more than 6%? What if you leave your job in 2 years? What if? I get it. You can torture data to get it to confess to anything. I'm not here to convince you to do this. I'm here to open up the idea as an alternative to paying all this interest to the bank. Indeed, I wish you never had that debt to begin with. But if it's there and it costs you more than you think your investments will grow, Don't overlook this option. No 401k? No problem. But what if you don't have a 401k? Say your only accounts are an IRA or even a taxable account like a bank account, mutual fund, or brokerage account. What should you do then if you have some debt at 10% and your expected return on your investments is 6%? In some cases, this is an easy call. In others, not so much. First, understand that the money you borrowed from your 401k came out tax-free. You will pay it back with after-tax dollars, but there is no immediate tax consequence when you borrow from your 401k. However, the money that comes out of your IRA will be taxable from the very first penny. Thus, when it comes to your IRA, does it make sense to pay taxes today and eliminate a debt, or defer taxes until later and slowly pay off that debt? My argument from the first chapter stands. Debt is your enemy. But you also need to factor taxes into the equation here. If your projected rate of return on your IRA is 6% and you pay the bank 10%, you are losing money. However, if you are in a 25% tax bracket, you will have to withdraw $13,333 from your IRA to pay off that $10,000 debt because it will cost you $3,333 in taxes. Worse yet, if you are under 59.5, you will also pay a 10% penalty to the IRS for the privilege of using your own money. With that additional 10% penalty on top of the 25% taxes, you'll need to withdraw almost $15,500 to pay off a $10,000 debt. As much as I despise debt, it's hard to make an argument to do that. This strategy is truly contingent on your tax bracket. But what if you have a non-IRA, i.e. taxable account? In this case, I would absolutely advise you to consider liquidating your account, pay that debt off, and never let it see the light of day again. First of all, there are no 10% penalties to the IRS for using your non-IRA money, regardless of how young you are. Also, taxable accounts have what is called a cost basis, which is the amount of money that you put into the account. When you sell a taxable account, you don't pay tax on that cost basis. For example, let's say you have $10,000 in a mutual fund account. Your initial investment was $7,500, so you have a $2,500 gain. When you sell, you will pay taxes only on that $2,500. The $7,500 is your cost basis and is returned to you with no tax. How long you've owned the account also determines your tax. If you've owned this account more than a year, your taxes may be as low as $375. This means it costs you $375 in one-time taxes to avoid paying nearly $1,000 a year in interest on your debt. That would be a pretty easy choice to make. Lastly, let me also revisit the idea about investment rates of return. Investments are not guaranteed. You could lose a lot of money. Let's say you have $10,000 in an investment portfolio and $10,000 in credit card debt. After 1 year, the investment portfolio at the 6% growth rate we've assumed will be $10,600. The credit card balance has increased to $11,000. Let's say the next year, though, is like 2008, during which investments fell 40% or so. In this case, your investment portfolio is worth $6,000, but your credit card balance is $12,100. In this scenario, would you rather have taken that $10,000 and paid off the credit card, even if it meant paying some taxes? Of course.